All right, hello everybody. I wanted to get a video out here this afternoon highlighting our new trade on Costco from this afternoon. So I want to walk you through why we ended up taking the trade, what we're looking for on the position. I know some of you had some difficulty getting fills on the trade, so I will show you some things that you can do to increase the odds of getting filled. I'll show it to you inside of Thinkorswim and then also inside of the Tastyworks platform as well. So let's dive in. Let's talk about the chart here. Just really quick. I know I've been talking all week about big picture market conditions. You guys have seen the wild movement back and forth. Finally got some relief on the upside, which it's amazing. The market, taking a look at the Dow futures, we're up almost 800. S&P up almost 110. The NASDAQ up almost 400. In any normal market, those would be crazy numbers. Impressive rally. Today, it's just a drop in the bucket because we've been down thousands of points here the last week or so. However, it's a start. And what we've been looking for, if we're going to get a move to the upside, a sustainable move to the upside. Let me pull up just the daily chart of SPY real quick. Some things that I've been talking about is I wanted to get a series of closes near the highs of the session. I want to close near the upper end of the range. That would show me that people are willing to take risk overnight. That has not been the case over the past couple of weeks, where everybody is just saying, get me out at any price going to the close. We're now starting to see a little bit of risk taking again. We'll see if that continues into day 2, 3, 4. The volume was, again, pretty large, up over 200 million shares. Markets were very, very wide. That has been the challenge. It doesn't matter if you're trading futures, stock, options. The markets are incredibly wide, and that can make it more difficult to get orders in place and get fills on trades, and I'll show you that in just a second. So I've wanted to see a close near the highs of the day. We didn't quite get to the highs at the close, but we did get a really nice rally. It's a start. We'll see what happens going into tomorrow's session. I've also wanted to see the internals improve. They were positive, but not overwhelmingly so. The volume ratios on the NYSE and the NASDAQ, both positive. 2-to-1 positive on both, so twice the volume on the upside versus the downside. It's a change from the last week and a half, but it's not the most impressive number. I want to see that improve over the next few days. The advanced decline line over a plus 1,000. It's a good number, not great. There's still some pockets of weakness in this market. The airlines continue to get crushed. Some of the financials, we had some strength in some of the financials. We had some weakness in the others. So mixed bag there in the financials. If this rally is going to continue, we need to see that rally in every area of this market, every sector, every stock, and we have not seen that as of yet. So going to an individual stock basis, the volatility in this market continues to remain very high. The VIX was down $9 today, but it's still above 70. We did not get the VIX contraction that I was expecting on an 800-point rally to the upside. You would expect volatility to contract more than it did. We are still seeing a lot of fear, a lot of uncertainty priced into this market. And as a result, the options are very, very expensive. It doesn't mean you can't buy options in this environment. You can certainly buy calls and puts. It's just more difficult because not only do you need the timing to be right on that trade. If you buy a call option, you need that stock to move to the upside quickly. And you need to make a big enough move to offset the volatility contracting, and that's going to happen if stocks start to rally here. As a result, I am more interested in credit spreads right now. I would rather sell a credit spread, take advantage of the high volatility, take advantage of the high prices of the options. It gives me a better profile on the trade. It gives me a better probability of success on the trade. Now, Costco specifically, you can see on Costco, the pulse indicator down at the bottom, the red, yellow, and green histogram. Over the last couple of days, we have seen a handful of yellow bars. We've seen a couple of green bars. The green bars are what were of interest to me. The green bars represent between a 2 and a 3 standard deviation move on the downside. In other words, we're very, very oversold. It doesn't mean Costco has to immediately bounce higher, but it does mean that odds favor either a period of consolidation or even a reversal to the upside. It means the chances of a big move lower from here it's slim. The movement to the downside has already been priced in. So expecting this market to bounce, we came in and we sold a put spread. The basis for the trade was the green pulse indicator representing an oversold condition. We then got a close above the 8-period exponential moving average. That's the red and the blue moving average right there. That's not required, but it is it's a nice step of confirmation. I don't have to have it, but when I see that, it does confirm that price action is potentially ready to move to the upside. And Costco, we know what's happened here worldwide, but specifically in the U.S. There has been a mass rush, right, to load up on supplies, food, water, toilet paper. I mean, you guys have seen the headlines, and Costco is a big benefactor of that panic. And as a result, the stock price has actually weathered the storm quite well and moving back to the upside. So let's go back over to the trade page here, and let's talk about our Costco trade. Now, the IV percentile down at the bottom is at 85, indicating that we are near the upper end of the range. We're near 52-week highs for volatility. Even though the stock hasn't gotten as beat up as other names, the market is still pricing in uncertainty there. When the IV percentile is above 50, it indicates that options are more expensive, and it has me more interested in using credit spreads. What we did is we came in and we used the April 9th, the weekly options with 23 days left to expiration. So let's go ahead and open those up. And from our alert earlier today, I mentioned we wanted to sell to open the 9 April 20, so the April 9 weekly options here. The 277.5, 275 put spread. So I went out to the 277.5 puts here. I right-clicked on those. I went to sell, and I selected vertical from the drop-down menu. Once I click on vertical, it'll pop up an order down at the bottom where I am selling the 277.5 put, and I am buying the 275 put at the same time. Now, we wanted to collect 70 cents or higher on the position. Well, you look at this and say, wait a second, it's trading for $1.67. That's way over the range that we posted in the alert. Here is the issue. The issue with a lot of these wide markets, and when I say wide markets, look at the bid and ask prices here. Look at the 277.5 puts. The bid price is $9.85. The ask price is $13. Right? There's over a $3 bid ask spread there. Same goes for the 275. The 275 puts have a $7.50 bid and a $12 ask. These are very wide markets. When volatility gets this extreme and the moves gets this extreme, what the market makers will do, especially at the end of the day, is they will widen out those markets. And that can cause a few different issues for us. First of all, some of you have already noticed this, your P&L can look off at certain times of the day. Typically, it'll happen in the morning and then in the afternoon, where your P&L looks either really good or really bad, right? And that's because they're widening out the markets. The P&L is based off of those bid and ask prices, right? So as they widen out those markets, it'll impact your P&L. So you can see some funky numbers there. Don't be alarmed by it. Normally, when the market opens the following day, the markets will tighten up and those P&L numbers will come back to normal. As far as this trade goes, so let's just say for our example, because this trade was pricing around 60 to 75 cents for most of this afternoon. It actually got up higher than that at one point this afternoon. So let's say you placed your order at 70 cents. Okay, that was the minimum price that I wanted to collect in the alert. And let's say you were not filled. There's a couple of different options that you have. You can let the order work at 70 cents and wait for the market to come to you and fill you, which could take a matter of minutes, a couple of hours. Maybe it doesn't get filled till the next day. That is your first option. The other option is to adjust the price. And if you're creating a sell order like this, we are trying to sell this spread to open up the position. In order for you to try to get filled faster, you're going to have to adjust your price lower. And as you adjust the price lower, the problem with that is it starts to give up some profit potential. When you sell a spread, whatever you collect, whatever you get filled at on this trade is the most you can make on the position. So we want to collect as much as we possibly can up front. In this case, let's say you started out your order at 75 cents and you were not filled. Okay, so you start to adjust the order down. You can adjust your order down by a penny or two. And as you adjust that order down, in most cases, as you adjust it down a penny or two, you're going to get filled within, I would say, 1 to 5 cents or so is where you would typically get filled. So again, you want to get the highest price possible, but if you're not filled on a sell order, if you start to adjust the price lower, it increases your odds of getting filled on the trade. The exact opposite is true. If this was a buy order and you can't get filled at your price, if you adjust the price higher, if you're willing to pay a higher price for that position, you're going to increase your odds of getting filled. I always start out at the mid price between the bid and ask, and then I adjust from there. So that's my approach that I take personally. So we got filled at 70 cents on this one earlier. And let me go ahead and adjust that price down. So we're risking $180 to make 70. Very typical range for us is risking 2 or 3 to make 1. We have 5 ways of making money on this position. We make money if the stock moves up, down, or sideways, as long as it stays above 276.80. That 276.80 number comes from taking our short strike, the 277.5 put that we sold. We're going to subtract the 70 cents that we collected to put the trade on, and that gives us our break even at 276.80. So up, down, or sideways, as long as the price stays above 276.80, we make money. We also make money from time decay adding up and from volatility decreasing. So there's 5 different routes that we can go here over the next few weeks to make money, which is really nice. It just gives us a more forgiving type trade. And in this wild market, I personally feel more comfortable using more credit spreads. It just gives me more peace of mind, because I know I'm in a risk-defined trade and I know I have 5 ways of making money. I think that is going to be the best route to go, especially considering current conditions. I think we're very much taking what the market's giving us here. All right, so I'll open up Tastyworks here in just a moment and show you how to place the trade there. Next, just real quick, if you get filled at 70 cents, our goal here is we are targeting between 50 and 75% of our max profit. So if we collect 70 cents, that's the most we can make on the trade. Therefore, my closing order, if I can get filled and buy that spread back for between 18 and 35 cents or so, that's going to be our desired outcome. I'm going to place my closing order right at 18 cents. That way the order is working for the next few weeks, and potentially we can get filled on that and book the profit. Of course, we'll let you know. We'll circle back and let you know when we're taking action on our side and taking the trade off. All right, let's go over to Tastyworks here. When I log into the platform, to place this trade, we're going to click on the symbol box up at the top, and we're going to switch the symbol to Costco. Down the vertical toolbar on the left-hand side, there is a box that says Trade. If you click on the Trade box, we want to make sure that we have it set to table mode. And once I click on table mode, this is the screen that you're looking at. This shows you all of the different expiration cycles down the left-hand side. It also shows you how many days are left to expiration. From the alert earlier, we mentioned we want to use the April 9th option. So I'm going to click on the April 9 options. It's going to load up all of the different strike prices down the middle that we have available to us. In the upper right-hand corner, you can click on that drop-down menu. If you need to load up more strike prices, you certainly can. I've got it set to 20. So if you don't see the strike prices that we send out in the alert, you can always load up a larger number of strike prices on that trade page. So that's exactly what I'm going to do here. Load up some additional strikes. And from the alert, we mentioned we wanted to sell the 277.5, 275 put spread. So to sell the 277.5 put, the puts are on the right, the calls are on the left. I'm going to go over to the bid price of the 277.5 puts. And I'm going to left click on those. As I left click on the 277.5 put, see how it now is boxed in red? That indicates that we're creating a sell order. We're selling the 277.5 put. To buy the 275 put, we're going to left click on the ask price. And as I do that, it's going to box it in green. That creates an order down at the bottom where it summarizes itself. I am selling one. That's what the -1 line stands for. I'm selling one 277.5 put. STO stands for sell to open. And then I am buying one 275 put. BTO stands for buy to open. I'm doing both of those at the same time. The price here in the middle, I can go ahead and change this to anything I want. So if we wanted to set it for 70 cents, you just type in 70 cents there. We can change the quantity just by clicking on the left and right arrows. Okay, so if I wanted to trade 3 contracts, I just left click a couple of times, and now your quantity goes from -1 and plus 1 to -3 and +3. You can change the order type. Anytime that we are creating a sell order, we want that set to a net credit. So that is correct. TIF stands for time and force. Right now it's set to a day order. If you click on the drop-down menu, you can change that to a GTC or a good till cancel order. For any type of an entry order, I prefer to use day orders. I would use GTC orders if it was a closing order. For a stop or a target, I don't have a problem there, but I do like to use day orders for the entries. So you just review it, make sure everything looks fine to you, click on review and send, and you can send the order. So that's how you place the trade inside of Tastyworks. If you have any questions on this one, let me know. You can send me an email, mike@netpicks.com. You can ask a question inside of Slack or post a comment in the NetPicks app. Otherwise, I'm going to wrap this video up here. We'll be back with you guys again tomorrow, see if we can get another trade or two on tomorrow again. If you have any questions overnight, let me know. Otherwise, I will be back with you guys over the next few days for our next new trade.